Very good day, students. In this video, we will understand the tax implications or the taxability in respect of employees' own contribution to Provident Fund. Okay, we are not talking about employer's contribution, but of the employee's contribution, his own contribution to Provident Fund. And sometimes students face difficulty in understanding the concept because of the changes to the whole taxability regime of provident funds which have been made on and off. Things have become slightly complex, so this video will help you to understand the concept well as far as employees contribution is concerned. So employees contribution, the contribution which an employee makes to the provident fund, and then interest which is credited to the fund on employees contribution. Okay, that means on the contribution that he makes. So as far as a statutory provident fund is concerned, employees contribution deduction is available under section 80C. So it's his own money, it's his own contribution, and therefore from the gross total income he can claim deduction under section 80C to the maximum limit of 1.5 lakhs under that section in respect of his own contribution to statutory provident fund. Now his contribution will earn interest in the fund. So in the case of statutory provident fund, interest is exempt, so it is not taxable. Okay, but interest is not exempt on excess contribution. So sometimes an employee may make contribution beyond a limit that has been prescribed in the law, which has been prescribed by the government. So that is the excess contribution, a higher amount of contribution. So interest on the excess contribution is not exempt, it is brought to tax. So this is what we will understand in this video. Now when we talk about recognized provident fund or RPF, as far as employees contribution is concerned, just like SPF, deduction can be claimed under section 80C. Now what about interest which is credited on employees contribution? Here you need to note basically 2 points, and in terms of taxability there are 2 layers which you need to make note of. One is that interest to 9.5% is exempt. Okay, now in SPF this 9.5% ceiling is missing. It's simply given that it is exempt, and the reason is that statutory provident fund is basically for government employees. So there the interest which is paid is never beyond the limit which the government intends. Okay, and therefore there is no need to prescribe for any limit in the case of statutory provident fund. But RPF is something which is created and maintained by the employer. It is approved under the Income Tax Act, and therefore it is recognized under the Income Tax Act, and therefore in order to prevent misuse of exemption in respect of interest, a limit has been prescribed. Okay, that means if interest beyond 9.5% is paid, then that excess will be brought to tax. So interest up to 9.5% is exempt, and practically in all the cases you will find that the interest that is paid in the case of RPF never goes beyond 9.5%. But this is what you need to make a note, that the limit is 9.5%. This is the first layer, and the second layer is basically the same as that for SPF. That means the excess contribution which an employee makes in the fund, interest which is on account of that excess contribution, which is related to that excess contribution, is not exempt, it is taxable. So in case of RPF there are 2 limits, one is in terms of percentage and one is in terms of an absolute amount of the contribution, and interest in relation to that excess amount is not exempt, it is taxable, and we will look at this in detail in some time. Now as far as unrecognized provident fund is concerned, as far as employees own contribution is concerned, deduction is not available under section 80C. So 80C cannot be claimed. 80C can be claimed in the case of SPF and RPF, but it cannot be claimed in the case of UPF. Interest which is earned, which is credited on employees contribution, it is exempt. It is exempt during the years while the interest is earned, but then taxability arises when there is lump sum payment of accumulated balance. So in that case, in the case of UPF, employees contribution which the employee receives as a lump sum payment is exempt, because it is his own contribution, it is not in the nature of any income, and on top of that he was not able to claim deduction under section 80C. So when he receives the same amount back in the case of lump sum payment of accumulated balance, it is not brought to tax once again. Okay, And as far as interest on employees' contribution is concerned, that was exempt all along, okay, is taxed in entirety under the head income from other sources when it is received, because interest on employees' contribution has got nothing to do with employer-employee relationship. It is his own money which he contributed, which earned interest, and when he receives that interest, why should it be taxed under the head salaries? So it is taxable under the head income from other sources, okay. Now, as far as Public Provident Fund PPF is concerned, as far as employees' own contribution is concerned, so in PPF it is not only an employee that can make contribution; it is open for all individuals. Okay, so anyone can contribute to PPF. It's a great investment option for the public at large. So for own contribution, ATC can be claimed, and whatever interest is earned is exempt. Okay, so this is about Public Provident Fund. But in this video, we are going to focus on Statutory Provident Fund and RPF. We are going to focus more on RPF because question in the exam has not been so far asked on Statutory Provident Fund. It is basically for government employees. The entire private sector has what we call as the RPF. So in the exam, we have been asked questions in the case of RPF, so this becomes more important for us. So in case of employees' contribution, in the case of SPF as well as RPF, ATC can be claimed, okay. And what about the interest on employees' contribution? In the case of SPF, there is no limit as far as interest rate is concerned, but in the case of RPF, there is a limit of 9.5%. This is one layer, and then there is a second layer. In case of SPF and RPF, both the cases, we need to figure out if there is any excess contribution made by the employee, and the interest which is relatable to that excess contribution, that is not exempt. We need to bring it to tax, okay. So now we will move to this concept where, as we just now discussed, interest accrued during the previous year relating to excess employees' contribution to SPF and RPF is not exempt, okay. So in the case of RPF, you will very often find that employees are contributing much more, okay. So usually what happens is if you look at the contributions that are made in the Provident Fund, okay, so employer's contribution in the case of RPF is exempt up to 12% of salary. So employer is contributing maximum 12% of salary, and employee is also contributing say 12% of salary, and this is what you find in most of the cases. But employee has an option to contribute amount in excess of 12%, okay. That is not taxable because only employer's contribution in excess of 12% is taxable. Employee can contribute as much as he wants. There is no limit of 12% in case of employee's own contribution. So employees tend to contribute excess amount or extra amount beyond the employer's contribution, beyond even 12% of salary. Why? Because there is a great incentive. Say the interest is earned at the rate of 8%. So they know that the interest will be exempt. So the employees want to contribute as much as possible. And this is sometimes what is called as VPF, Voluntary Provident Fund Contribution, okay, because it is made voluntary by the employees. And the interest which then they earn on this excess contribution, also the whole of the interest gets exempt if it is within the 9.5% limit. Now the government realized that this is not good, this is not justified, because it really benefits who? It really benefits the high net worth individuals. They've got lots of money. They know that if they were to invest this money outside, that will either result in capital gain or the interest income will get taxable, okay. And they know that if they were to voluntarily invest a higher amount as their own contribution in Provident Fund, interest will be exempt if it is up to 9.5% per annum. No matter what is the absolute amount, the entire amount will be exempt. So basically the result is that this exemption provision was benefiting only the high net worth individual at the cost of the exchequer, at the cost of the government, because government was then giving exemption and the government was not getting any tax revenue, even when these high net worth individuals were investing huge amounts of money merely to claim the entire amount is exempt. So to counter this, what has been done is a limit has been prescribed, okay. And if the employee contributes beyond this limit, then the excess contribution beyond this limit, the contribution itself will not be taxed. The contribution itself will not be taxed, but the interest which is related to that excess contribution will be brought to tax. It will no more be exempt. Okay. So this is the objective behind this particular provision. Now, what is the provision? Let's look at that. So interest accrued during the previous year relating to employees' contribution. That means we are not talking about employees' contribution here, only the employees' contribution. Exceeding the following limit is not exempt. Okay. So interest relating to excess employees' contribution is not exempt, it is taxable. And here we need to categorize the interest into two parts. Basically, we need to categorize the contribution into two parts: contribution till previous year 2021, okay, contribution from previous year 21-22, okay, because from previous year 21-22 this particular provision has come into force. So it is not retrospective, it is prospective. That means whatever contribution has been made by the employee till previous year 2021, the entire interest relating to that contribution will remain exempt. So there is no limit which is applicable here. Whatever the employees have done, they have done. The government is willing to forego taxability, and the government is willing to provide exemption of whatever be the amount of interest, whatever have been the amount of contribution, no matter how high it was. Okay, so this is till previous year 2021. Now what you need to find out is the contribution which has been made by the employee from previous year 2021-22 and onwards. Okay, now here there is a limit, and the limit is basically 2.5 lakh per year. So the government says 2.5 lakh per year of employees' contribution is a reasonable limit, and we are willing to provide exemption in respect of this contribution, interest on this contribution. But beyond this limit, it becomes excessive, and we are not willing to provide exemption in respect of interest related to that excess contribution which goes beyond this limit. Now this 2.5 lakh per year limit is applicable where the contribution is made to the to SPF or RPF both by the employee and employer. So this is what we find in most of the cases. Okay, so in RPF it is the employee who is contributing, and the employer also contributes. For employer there is a limit of up to 12% of salary for exemption, but for employee contribution there is no limit, but for interest purpose this limit of 2.5 lakh has been provided. Okay. Now this limit is basically doubled to 5 lakh per year in case where there is no contribution by the employer to the fund. So employer is not making any contribution, only the employee is making contribution. This happens mainly in the case of statutory provident fund, where the employee, the government employee, is supposed to contribute. Now in that case, the 2.5 lakh is doubled to 5 lakh because only one person is making the contribution, the other person or the other party is not making the contribution. Okay, so interest on employees' contribution up to this limit remains exempt, but interest relating to employees' contribution exceeding this limit becomes taxable. Clear? How is taxable interest computed? There is a rule. There is Rule 9D which has been prescribed. Okay, and for this, separate accounts within the provident fund account are maintained. Why separate accounts need to be maintained? Because one account will relate to the non-taxable contribution and the other account will relate to the taxable contribution. Okay. Interest which is accrued in the non-taxable contribution account will remain exempt, but interest which is accrued in the taxable contribution account will become taxable. What will be the composition in each of these accounts? This is highlighted under this table. So there will be two accounts, non-taxable contribution account and taxable contribution account. These two accounts will be maintained under the provident fund for each employee. Now, non-taxable contribution account. Closing balance in the account as on 31st March 2021. All the amount, this entire amount will fall under this non-taxable contribution account, because till 31st March 2021 there is no limit. The limit applies from previous year 21-22, that means from 1st April 2021 onwards. So till 31st March 2021, whatever is the balance, it will go under non-taxable contribution account, because the entire interest which is earned on this particular closing balance will remain exempt. Okay. To this, we add any contribution made by the employee during the previous years 2021 and subsequent previous years. Okay, previous year 21, 22 and subsequent previous years. Now here, the contribution will need to be split in two parts. Up to the threshold of 2.5 lakh or 5 lakh as the case may be. Okay, that will go to non-taxable contribution account, because up to this limit, interest will be exempt. So it will go in non-taxable contribution account. The excess, the amount exceeding this limit, will go in the taxable contribution account, because interest thereon will become taxable now. Okay. Interest accrued on number 1 and number 2. Okay. Now this is the closing balance and this is the contribution which has been made. So obviously interest will be accrued on this balance as well as on this balance. So interest which is accrued on this non-taxable portion will remain exempt. So interest will be added. And interest accrued on 1 and 2. 1 is actually not here, only 2 is here. So interest accrued on this particular amount will become taxable. So interest also will be added to the account. Any withdrawal, if any, from such account will need to be reduced, and that will give us the balance. Okay, and this will be repeated. So this means that this balance will become the opening balance of the next year. Okay, and then the person will make new contribution for the next year, and this will again be split, and then interest will be accrued on this and this, on this and this, and that will be added. Any withdrawal will be adjusted, and the cycle will be continue to be repeated. Okay, so this particular number 3, interest which is accrued on number 1 and number 2, in the case of non-taxable contribution account, for every year it will remain exempt, and this interest which is accrued on this balance as well as on this balance, okay, will become taxable every year. So this is the amount that you will bring to tax in every year. So in effect, only the interest relating to the employee's contribution exceeding the threshold of 2.5 or 5 lakh, as the case may be, made on and from previous year 21-22 is taxable. Interest relating to all other contribution remains exempt. Okay. So what you need to note is interest will not only arise on this contribution, but this contribution and the interest thereon will form part of the closing balance, which will become the opening balance, and then on opening balance again the interest will accrue, including interest on the new contribution made during the next year. So since interest is compounded, so interest will accrue on the interest, because interest of the previous year will also form part of this balance. Okay, so interest basically will be the interest on the contribution made in the current previous year, as well as the interest which will accrue on the opening balance, which opening balance will also will not only include the contributions of the previous years, but also the interest on those contributions of those previous years. So this is how it works, right? Now let's look at some points. Interest relating to employees' contribution made till previous year 2021 is fully exempt, irrespective of the amount of contribution, even if the interest is accrued after such previous year. Okay, because this whole balance will remain in the non-taxable contribution account, and it will remain exempt even after previous year 21-22. This whole interest relating to contribution till previous year 2021 will always remain exempt, whatever be the absolute amount, and in all the years to come it will remain exempt. Okay, next point. The limit of 2.5 lakh or 5 lakh stated above applies to employees' contribution only. This is what we need to make ourselves very clear. What is taxable is the interest relating to the excess contribution, not the amount of contribution itself. So if, say, the employee contributes 3 lakh in the year, where both employee and employer are making contribution, and 2.5 lakh is the limit, 3 lakh, so 50,000 is the excess. So 50,000 will not become taxable. Interest on 50,000 will become taxable. Okay, this is what you need to be clear of. Next point. If the employee's contribution is within the above stated limit, okay, for example, the employee's contribution is say 2.5 lakh, so it is within the limit, it is not exceeding 2.5 lakh. Related interest will also remain exempt irrespective of the amount of interest. Whatever be the amount of interest in absolute terms, it doesn't matter. because the amount of interest will also keep increasing, because interest for the current year, it will form part of the balance, and the next year interest on interest, and then interest on interest, and then interest on interest. So the amount of interest will also keep growing, but all that interest will remain exempt under the non-taxable contribution account, and all the interest will become taxable, which is arising under the taxable contribution account. Clear? This provision does not apply to UPF, unrecognized provident fund. It only applies to SPF and RPF. In unrecognized provident fund, what we saw in the table sometime back is while it accrues, the interest remains exempt. But when lump sum payment is made of accumulated balance, the entire interest becomes taxable under the head income from other sources. So this provision doesn't apply to UPF, it only applies to SPF and RPF. Now what about employer's contribution and interest thereon? It is treated differently. This provision applies only to the employee's contribution and interest thereon. It doesn't apply to employer's contribution and interest thereon. There is a separate video that I will make in terms of employer's contribution, but this video is only for employees' contribution. Let's look at an example now. Rachna is employed with PQ Limited, drawing basic salary of rupees 2 lakh per month and DA forming part of retirement benefits of 25% of basic salary. Okay, this is the salary structure. Now she contributes 12% of her basic salary and DA to her EPF account. So this is RPF. Okay, this is employee share. She is contributing, with PQ Limited making a matching contribution. So PQ Limited is also contributing 12%. Interest is credited to the EPF account at the rate of 8.1%. Right? 8.1%. Closing balance in her account, that means employee share. Closing balance in her account, the employee share is rupees 50 lakh as on 31st March 2021. Okay, this is not the employer's share balance, this is the employee shares balance. This is 50 lakh as on 31st March 2021. Analyze the tax implications for previous year 21-22. For previous year 21-22. And we have noted that this taxation applies in respect of excess contribution from previous year 21-22. So we will just see how it works. So Rachna contributes rupees 3,60,000 to the EPF account. How? Because basic salary is 2 lakh per month and DA is 25% of basic salary, and the aggregate of this is what? The aggregate of this is 30 lakh, and 12% of 30 lakh is being contributed. So basically 3,60,000 per year is being contributed. So Rachna contributes 3,60,000 to her EPF account, and PQ Limited is also making the matching contribution. Now what about PQ Limited's contribution of 3,60,000? It is employer's contribution. It is exempt because it is up to 12% of salary, which is what we saw in the table also. Employee's contribution up to 12% is exempt. Beyond 12% it is taxable. So in this case it is exempt. What about interest? Interest on employee's contribution is also exempt because it is up to 9.5%. And interest on Rachna's own contribution, the first layer, 9.5%, that is being fulfilled because interest is up to 9.5%. So the first layer is exempt. Okay. Now Rachna can claim deduction under section 80C in respect of her own contribution to the extent of 1,50,000. She is contributing 3,60,000. 80C can be claimed up to 1,50,000. Okay. So till this point, things should be very clear to you. She is contributing 3,60,000. PQ Limited is also contributing 3,60,000. As far as contribution of PQ Limited is concerned, it is exempt as it is up to 12% of salary. As far as interest on PQ Limited's contribution is concerned, it is also exempt as it is up to 9.5% of salary. And in the same fashion, Rachna's contribution, interest on Rachna's contribution, as far as the first layer is concerned of exemption up to 9.5%, it is exempt. But when we come to the second layer, which we discussed in this video, excess contribution beyond 2.5 lakh. Interest relating to her own contribution exceeding 2.5 lakh. Why 2.5 lakh? Because both the employer and employee are contributing in this case. Both are contributing, therefore the limit is 2.5 lakh. So we need to see whether the contribution of Rachna is more than 2.5 lakh. Yes, because it is 3.6 lakh. So interest relating to her own contribution exceeding 2.5 lakh, which is what? 3,60,000 minus 2.5 lakh. It is 1,10,000. So interest relating to this 1,10,000 will not be exempt. Will not be exempt. And therefore, as we saw above, separate non-taxable contribution account and taxable contribution account will be maintained as per Rule 9D in the Provident Fund. And the amount available under both the accounts as at the end of the year, previous year 21-22 in our example, would be computed as depicted below. Okay, so this is non-taxable contribution account and this is taxable contribution account, and we are looking at previous year 21-22. So closing balance on the account as on 31st March 2021, it is given in the question. It is what? It is 50 lakh. And since this is before previous year 21-22, the entire amount will go in the non-taxable contribution. That means the interest thereon will remain exempt forever. Now we will look at contribution made by Rachna during the previous year 21-22, and here we will need to split the contribution of 3,60,000 into 2,50,000, which is the exempt limit, and the excess 1,10,000 will go into the taxable contribution account. Interest which is accrued on number 1 and number 2. Okay, for example, this is 4,19,044. This is the interest on this balance. This will continue to be exempt, and therefore this will go into the non-taxable contribution account. Interest on 1,10,000 will be, for example, 2,362. Since it is related to the excess taxable contribution, it will form part of taxable contribution account, and this 2,362 will become taxable. It will not be exempt. And less withdrawals. In our example, there are no withdrawals. So opening balance in the account on 1st April 2022 will be the total of this and the total of this. Okay, so interest for the previous year 21-22 or 4,19,044 will be exempt. Interest of rupees 2,362 will be taxable. Now when the interest will be taxable, you will also need to check whether TDS provisions will apply. Now you will find that the TDS in such case will be applicable under section 194A, interest other than interest on securities, and the rate will be 10% under that provision. So 10% will be deducted and the balance interest will be paid depending on the provisions of 194A, the threshold, etc. Okay, for deduction of TDS, that will need to be checked. If the TDS is deducted, the balance in the taxable contribution account will be the amount after deduction of TDS. Okay, minus TDS, and this will be the balance after deduction of TDS. In this example, TDS has not been considered. Computation for previous year 22-23. This is 21-22. What about the next previous year? This amount will go here. Okay, this amount 112,362 will go here. If the details remain the same, then again 2,50,000, and this amount will go here, this amount will go here, and then again 2,50,000, 1,10,000 if the details remain the same, and then again the interest accrued, and the interest accrued here it was 2,362, but for next year interest accrued on this plus this plus this, the opening balance plus the contribution for the current year, the interest, and then that interest will become taxable for previous year 22-23 and so on and so forth. Okay, so it will continue like this. It will be done onwards in a similar manner. So this is how this provision works. Okay, so just to summarize in nutshell, as far as SPF and RPF are concerned, employees contribution, ATC can be claimed in both the cases. What about interest on employees contribution? For SPF it is exempt. There is no limit because it is not required in terms of percentage, but in case of RPF, a limit in terms of percentage is required, and therefore it is 9.5%. This is the first layer. The second layer of exemption remains common across SPF and RPF, and that means the interest on contribution up to the limit of 2.5 lakh or 5 lakh. But what about the excess contribution? The interest related to excess contribution becomes taxable both in case of SPF and RPF. What about unrecognized provident fund? The interest remains exempt throughout its accrual, but at the end, at the time of lump sum payment of accumulated balance, the entire interest gets taxable under the head IFOS, while the employees on contribution which is received back, it is not taxable because it should not be taxed. It remains exempt. Okay, and as far as PPF is concerned, as far as UPF is concerned, ATC is not available. As far as PPF is concerned, employees contribution, just like SPF and RPF, ATC can be claimed, and interest remains exempt, and lump sum payment of accumulated balance also remains exempt. And we then discussed about this limit of 2.5 lakh or 5 lakh as the case may be, and then how it works, and two accounts are maintained, and the interest which accrues on the balance in the non-taxable contribution account remains exempt. Interest which accrues in the taxable contribution account becomes taxable. Okay. The TDS provisions apply under section 194A. So this is how things work. So hope this concept is clear to you. If you have any doubts or comments or you need any clarification, do write in the comment box. If you have got my WhatsApp or Telegram number, just call me or write to me directly. I'll respond to you as soon as possible. See you very soon in my next video. Good luck and goodbye.